Hi, everyone. I'm Parker Gerard with Evolve Advisor Group. Thanks for joining me. Today, I'm walking through our Q4 market review and sharing our outlook for 2026. This past year brought its shares of surprises, opportunities, and important shifts across the markets. And my goal is to break it all down in a clear, practical way so you can feel confident about the road ahead. Let's take a look at what shaped the final quarter of 2025 and what we're watching as we move into the new year. Moving on into our market review of Q4, we ask what was the best performing asset class in Q4? As you think on that for a second, let's just recap 2025. If you recall, in the first quarter, we had Mag 7 that really underperformed. Tariffs were announced in early April with a very big drawdown, and then a really big jump back shortly after that. So, for those of you that answered emerging markets or maybe non US stocks, that's the correct answer for the year. But actually, for the fourth quarter, it's commodities. Commodity prices were really driven by gold and particularly a late year end rally for silver. Now, commodities is always a little difficult because depending on what index you look at, it may or may not have precious metals as a really big exposure. But you'll see here in the fourth quarter, commodities up almost 6%. But except for real estate, we had another quarter of risk assets in positive territory. Equities led the way, emerging markets and non US outperforming US. So many of these themes are continuing from earlier in the year. And then we take a quick look at overall 2025. You'll see almost 34% returns in emerging markets for the calendar year. I also want to highlight fixed income, which had strong positive numbers across the board after multiple years of negative returns. We have been firmly in the state of the Federal Reserve starting to cut rates. With a little bit more stability on the long end of the curve, we've been able to see fixed income assets perform quite well. I mentioned earlier some of the volatility that we saw, particularly in technology and communication services. So those sectors were down quite significantly, but then rallied. So depending on what portion of the year we were looking at, we can get different answers. But if you go from the beginning of the year to the end of September, the worst performing sector was healthcare. It's not totally surprising because this is a sector that can get very wrapped up in politics. And this was certainly a big topic of discussion for the first 3 quarters of the year. If we take a look at sectors across the fourth quarter, you'll see healthcare really rebounded in the fourth quarter, which is remarkable. It was the worst performing sector in the first 3 quarters of the year, then the best performing sector in the fourth quarter. I like to highlight this because a lot of times politics can have a really big impact on stock performance, but this tends to be relatively short-lived. Ultimately, investors decided that some of these policies were not going to be as bad as feared and started to find some interesting opportunities within healthcare. One of the main opportunities that we are seeing is that healthcare is leaning into AI more than many of the other sectors, and they're moving into that area much more effectively. And so the market is starting to see that. If we look at the sector performance for the entire year, is that healthcare really moved from last place to fifth place on the chart for the full year return. Those strong returns really moved its overall return, and it's now at an above average return relative to all other sectors, despite the fact that every other sector had a positive return for the full year. This level of dispersion is fairly normal within sectors, but to see an individual sector jump that quickly from worst performing for 3 quarters all the way to fifth is really unusual. Moving on to fixed income, we've seen some interesting trends there as well. The black line is essentially the yield curve at the beginning of the year. It had gone from inverted, except for the very front end of the curve, to mostly upward sloping in most areas. Everything up to the 20-year bond had a decrease in yields, which is generally seen as what we call a bull steepener environment, which is positive for markets. The Fed is incredibly important this year for what they do in policy. The Fed minutes come out after the meeting. On the left-hand side is what the Fed discussed at the beginning of the year. In the middle is what they discussed halfway through the year, and then we see what they discussed at the end of the year on the far right. Bigger text means those words were said more often. And the color of the text is either yellow for hawkish views, blue for dovish views, and then dark blue for more neutral views. Some of the themes were important throughout, like inflation. Inflation was talked about in all of the meetings throughout the year. But it's so interesting how it started the year incredibly hawkish and then became completely dovish by the middle of the year, which is a complete flip, and then ended the year more neutral. So there's been a lot of change, and we expect that probably the Fed meetings this year will look similar. Labor is the other topic that's been on their mind. And labor has gone from sort of a neutral view at the beginning of the year to definitely dovish now. Now, with the most recent government shutdown in the first 2 months of Q4, it's made the labor market data a little noisier. With the most recent data that came out this week, there's just been a lot of noise in that data. And so some people are interpreting it slightly dovish. What we're thinking is that inflation, we shouldn't have a strong view on whether it's going to come down or up from here. But what we do know is that inflation is currently above the 2% target that the Fed has set. And it's unlikely that we're going to actually get to 2% inflation this year. But the labor market without immigration, those absolute numbers are going to be tough for a lot of jobs to be created in 2026. The unemployment rate might not go up as much, but it's probably not going to be as strong of a labor market in 2026. Okay, moving on to stocks and bonds. So we know AI is this huge opportunity, and it's been a massive driver in the market. Just a reminder, from 2023 through 2024, you had NVIDIA was up 800%. Even with the hyperscalers and semiconductors doing really well during that period, nothing could take whoever the leader was in developing capabilities in AI. 2025 was different though. We saw again very good performance, but performance was more dispersed than just NVIDIA and a handful of other names. Semiconductors is really interesting, up 71% in 2025. NVIDIA really was fabulous. But NVIDIA's competitors, who are less active, specifically in the AI space, actually outperformed NVIDIA. You'll see industrials, another area we'll dig into more, outperform the S&P 500. So we're beginning to see other stories come into play. Only 2 of the Mag 7 outperformed the S&P last year. Because they were so large, they still had really large contributions to the S&P 500 return, but it was only 2 names that were able to outperform. Everybody else was in many ways well below what the S&P 500. If we looked at them in aggregate, starting in 2023, that Mag 7 was 2/3 of the return for the S&P 500. 2024, they were a little bit more than half. Now in 2025, they're a little bit less than half. So the Mag 7 is still really important, but we have to make sure that it's not the only thing in our portfolios. There's actually an ETF of the Mag 7 called MAGS, M-A-G-S, that was launched in early 2024. So despite those 7 companies contributing 47% of the S&P 500 return, MAGS actually underperformed the S&P 500 in 2025. And so far this year in 26, MAGS is actually down 1.4%, while the S&P is up. Let's spend a moment talking about non-US stocks. Internationally, it's a bit different. Where in the US, we're dealing with historically high valuations. Outside the US, it's really the opposite. Here we're looking at these blue bars as the range of valuations of all of the mentioned regions. The line is the average over the last 20 years, and the dot is where we are most recently. If you look at the US, we're pretty much the only region that's really at the top of that range. Other regions are a little bit above average, but much closer to their long-term average. So we think it's really important that we all continue to have access to or exposure to markets outside the US, especially as they've become smaller and smaller portions of the overall market indexes. I'll end the way I often do, which is one of my favorite charts and stocks for the long run. Despite all the day-to-day moves in the market, stocks remain the best asset class to be able to grow wealth reliably over time. Thank you for taking the time to stay informed and engaged. As always, if you have questions about your plan, your portfolio, or how these trends may affect your long-term strategy, we're here to help you navigate the path ahead with clarity and confidence. Wishing you a strong start to the year, and I look forward to connecting with you soon.